good morning. This is Three Clowns, episode 25, Friday, May 8th. Yesterday's market got a little spooky. Tech held the line while everything else got nervous, and now we've got oil spiking on overnight geopolitical noise and futures doing their best to pretend that doesn't matter. Let's dig in.
Morning. Futures ignoring oil is always a nice phase, right before they remember what oil is.
Morning. Tom, you have to love the optimism of a futures trader at 4 in the morning. It's like they think if they just don't look at the crude chart, the transport costs won't actually exist. Good to be here, guys.
Yesterday, I tried to fix a squeaky door and somehow ended up pricing industrial lubricants in bulk like I run a mid-sized logistics firm. I don't even know which door it was anymore.
Tom, please tell me you didn't actually order a 55-gallon drum of lubricant for one bedroom hinge. I saw you looking at those viscosity specs yesterday, and I genuinely thought we were prepping for a supply chain deep dive.
Quick housekeeping. We're taking a short break next week, back with you Monday the 19th. But right now, let's run the board. Small caps and old economy sectors took a clear hit yesterday with the Russell ETF down 1.58%. Energy equities couldn't catch a bid even with crude ticking higher, the energy ETF down 1.84. The frothiest AI and space trades gave back gains, AMD down 3% and RKLB and ASTS getting absolutely smoked. Memes and crypto bled red again. GME down 4.8, AMC down 7.3, Bitcoin down 1.7. Crude firmed overnight on renewed U.S.-Iran tensions with fresh military clashes reported. Overseas, central banks just hit a record in Malaysian bonds. The IMF is sounding alarms on AI's systemic risks. ESG tensions flared when a U.S. fund targeted TotalEnergies over its offshore wind exit. Sanctions risk pushed a Canadian miner to pull out of Cuba entirely. Private credit gets a transparency jolt. Apollo will publish daily marks on its $800 billion portfolio. Whirlpool warned of recession-level appliance demand and shares tanked 12% after hours. And futures are pointing higher this morning with AI bellwethers out front, NVDA up 1.1 pre-market and Microsoft closed yesterday up 1.7. So here's what's actually happening underneath all this noise. Mega-cap tech is holding up because the market has decided AI ROI lives only at the platform level. NVIDIA, Microsoft, the ones with moats and cash flows that actually justify the valuations. Everything else in the AI trade, from the picks and shovels to the pure-play AI upstarts, is getting repriced downward. That's not volatility, that's a rotation that's starting to feel structural. Meanwhile, you've got this weird inversion, where crude's spiking on geopolitical risk, but energy equities won't follow, which tells you ESG policy and long-term derating is stronger than any one-day oil move. And then Whirlpool walks in and says, actually, consumers are breaking, which should matter a lot more than it does right now given the Fed's supposed to be data-dependent. The market's telling us it believes in the AI narrative and almost nothing else. Tom, from your angle on tech and capital flows, is this narrowing of leadership to just the platform name something investors should be worried about, or is this just rational reprising away from the hype?
It's both, but the order matters. The market's basically saying the only place AI cash flows are real, near-term, and defensible is at the platform layer. The hyperscalers and NVIDIA because they control distribution, compute, and pricing. Everything else is a derivative on that spend, and derivatives get repriced first when the cost of capital or uncertainty ticks up. The IMF warning is the tell here. They're not saying AI is bad. They're saying the system gets fragile when too much capex and expectation concentrates in a narrow pipe. So high beta AI names, your AMDs, your RKLB and ASTS type trades, they're being forced to reprice because they need the cycle to go right to justify themselves. The platforms don't. They just need it to go at all. And you can see the test happening in real time. Oil up on actual physical risk. AI up on narrative durability. If both can't be right, the stuff without cash flow today loses first.
That platform versus derivative split Tom's talking about is actually being enforced by the bond market right now. When you see that 10-year yield at 4.39% and climbing, even with those Iran headlines, it tells you the market is finally smelling the smoke from my inflation basement again. Well, it's not that the Fed isn't swinging the sledgehammer. They are. It's just that it's only hitting the people who actually need to borrow money or buy a dishwasher. Poor Whirlpool is getting the full force of that swing, while the big hyperscalers are basically sitting in a bunker made of cash and nuclear power agreements that the Fed can't even reach. So the platform names aren't just winning on tech. They're winning because they're the only ones who can ignore the fact that the cost of capital is staying higher for a lot longer than the narrative promised.
So what you're both saying is the Fed sledgehammer only works on people who can't ignore it, and the platform layer is basically immunized by their own balance sheets and pricing power. That takes us straight to the tape. Microsoft instead of meanwhile the stuff this retake from its there's doctorate in that belt where Shin said and gets of widely's birthrights. Så noterat fort by chiget will devoid be the mighty could take some of a kelly bailey lover greg into its Simon table with him he's still to get to the Davidois hands could you give back or get it up for academic and reverse cup.
Feels like funding pressure, not belief change. You sell the stuff that can't defend itself to keep the AI winners intact. Question is, when that stops being enough, do they finally have to touch NVDA and Microsoft, or does new money actually show up here?
Tom, you're hitting the nail on the head. That 10-year yield climbing toward 440 is acting like a giant liquidity vacuum for the little guys. The Russell ETF is getting crushed because their debt is repricing in real time, whereas those mega caps are basically acting as the world's most expensive savings accounts because they don't actually need to borrow. But if the Fed keeps this pressure on, even a safe AI narrative eventually has to answer to the cold math of a 5% risk-free rate.
So here's the thing that's actually weird this morning. And I mean structurally weird. Not just crude went up and energy went down weird. The energy ETF dropped 184 yesterday, while the oil ETF, which is basically just a crude proxy, went up 76 basis points. That doesn't happen in a normal market. That's not noise. Then overnight you get fresh Iran-US military stuff, crude firms further, and this morning the oil ETF is already down 167 pre-market, so crude's giving back gains. But the real story is what happened to Total Energies yesterday. A U.S. fund threatened to divest them entirely because they're abandoning their offshore wind commitments. So you've got capital literally threatening to leave an energy company not because crude's going down, but because the company made the wrong choice about renewable transition. That's ESG enforcing itself through the only language energy markets understand, divestment. The divergence between crude spot prices and energy equities isn't about barrels anymore. It's about whether these companies are deemed compliant with the policy and capital direction that matters to the marginal investor. Tom, is this derating permanent, or does it flip the second crude actually stays elevated and these companies have to start talking about returning cash instead of energy transition?
It flips the second cash shows up consistently. Markets forgive everything if you wire the money. Right now it's pricing political risk as a permanent tax on those cash flows, so you're getting a lower multiple even with decent oil. The moment buybacks and dividends outrun the ESG penalty, that discount collapses pretty quickly.
Right, but here's what's actually eating at me this morning. And it's bigger than energy or small caps individually. You had AMD down about 3%, Rocket Lab down 720, AST Space Mobile down 750. These are the high beta AI plays, right? The ones that were supposed to be the picks and shovel story. And NVIDIA and Microsoft basically held. That's not a healthy correction in the AI thesis. That's a quality within AI rotation, where the market is saying we believe in the mega-cap platform layer, but the speculative tier is getting priced out. Then you flip over to the meme basket and it's the same picture. GameStop down 4.8, AMCD down 7.3. Ryan Cohen just sent a bank letter questioning the whole eBay deal, so you've got retail conviction literally evaporating in real time. Crypto's down 2. Bitcoin down about 1.7 overnight, and Coinbase off 253. So speculators are de-risking across AI, space, memes, and crypto all at once. That's not a rotation, that's a wholesale pullback in risk appetite outside the mega-cap moat. And then you've got Sherritt, the Canadian miner, announcing they're exiting Cuba entirely because of Trump-era sanctions fears. That's not demand-driven, that's capital allocation responding to policy risk. But the thing that actually made me stop this morning was Whirlpool. Down 12% after hours on a recession-level appliance demand warning. Not guidance cut, recession-level demand. That's not a company problem. That's a consumer problem. The consumer is actually breaking under elevated mortgage rates near 5%. And if the consumer is breaking, and memes and speculators are being priced out, and policy risk is rewriting the capital allocation map, then the everything's fine narrative doesn't just have cracks, it has fractures. Ray, does a recession-level appliance demand warning from Whirlpool actually change the Fed calculus at all? Or are they still pricing this as transitory weakness?
Alex, the Fed looks at Whirlpool and sees mission accomplished because they've been waiting for these yields to finally suck the air out of interest rate-sensitive spending. But don't expect to pivot just because people stopped buying fridges. They're going to let the consumer grind against that 440 yield until the labor market snaps. Because to them, a smoldering inflation basement is a much bigger threat than a few unsold washing machines.
So what we're actually watching right now is this. The market's made a choice to believe in the mega-cap AI platform layer, and it's willing to price literally everything else as the cost of that conviction. Speculators, small caps, energy, consumer discretionary, crypto, even the picks and shovels AI plays. They're all getting sold to keep NVDA and Microsoft bid. The question isn't whether that's a healthy rotation anymore, it's whether it holds, because the moment it cracks, there's nothing underneath to catch it. So, today we're watching three things. Does AMD hold that pre-market bounce and prove the semi-story still has legs? Does the energy ETF find a bid if crude stays firm overnight? And whether Whirlpool's recession warning starts bleeding into small-cap sentiment more broadly? Those three questions tell us whether this is a one-day de-risking event or the first domino in something messier. So if the answer to any of those three is yes, we're going to need to understand what's actually broken underneath, and that's what Footnotes is going to show us. So we've got a handful of secondary stories today that actually show some real structural stress underneath. Energy equity divergence, geopolitical oil risk, some debt market signals, and a couple of corporate decisions that tell you something about how the world's actually repricing itself. Ray, you've been flagging some of these?
Oh, absolutely. I was actually reading the Total Energies footnotes yesterday evening, and the dissonance is just incredible. We had those military clashes with Iran overnight, which usually sends everything energy related to the moon. But while the crude proxy rose 0.76%, the energy ETF was down nearly 2% yesterday, and gold didn't even budge. Why? Because the market is starting to treat these geopolitical spikes as noise rather than signal, especially when you see Kalshi traders pricing in a high chance of a nuclear deal by 2027. It tells you the forever war premium isn't being bought by the big money anymore. And when you add in that fund threatening to divest Total Energies just for exiting offshore wind, you see the structural trap. We're essentially in the inflation basement, or the heat is rising because the 10-year yield is sitting at 4.39%. But the equity market is terrified that the long-term cost of doing business in oil is just too high regardless of the price per barrel. It's a massive derating happening in real time.
So if the multiple's structurally capped, do these guys just stop investing? Like what actually gets greenlit at the board level if higher oil doesn't re-rate the equity? Or does crude have to go properly stupid before anyone cares again?
That's the trillion-dollar question, Tom. They don't just stop, but the hurdle rate for anything new gets hiked through the roof because the board knows the market won't reward the growth. If the multiple is capped, you just pivot to being a cash flow machine. You buy back shares, pay the dividend, and only greenlight projects with such a massive margin of safety that even the divestment crowd can't ignore the math. And you can see the same capital exits on policy risk logic playing out with Sherritt, the Canadian miner. They just pulled out of Cuba entirely because Trump-era sanctions risks made the math unworkable. Nobody's waiting around to see how the policy evolves. But look, while that energy transition friction is grinding things down, something really wild is happening in the plumbing of the global bond market. We just saw foreign central banks push their holdings of Malaysian government bonds to a record high. Now, you have to ask yourself why an official institution, not a fast money hedge fund, but a central bank, is loading up on Malaysian local currency debt when the US 10-year is still sitting right there at 4.39%. It's because the narrative that the US Treasury is the only safe port in a storm is starting to fray at the edges. These banks are looking at the fiscal path in the West and deciding that diversifying into stable EM local debt is actually a lower risk move for their reserves. It's a quiet signal of confidence in Malaysia's macro stability, but the bigger story is that the official money is starting to absorb EM debt at a scale we haven't seen. They're essentially hedging against the volatility of supposedly risk-free US rates.
Ray, so is this Malaysian bonds record actually the tip of a bigger structural move? Central banks genuinely rotating out of dollars into EM local debt, or is it just noise in a small market that happens to be attractive right now?
Pertain in the Stresian market, which is a massive signal that the old safe Boris Irapti pertain. Stretfolds at Berdolby,
If you're marking that book daily, aren't you basically importing public market volatility into something that sold itself on being smooth? Does that compress spreads because everyone can see the same price? Or do investors actually pay UP for the honesty when things get weird?
That is the ultimate trade-off, isn't it? You're right, Tom. They are absolutely importing that public market nausea into their own backyard. But I actually think investors pay up for the honesty because it kills the black box discount. When you can see the mark every day, you don't have to price in a massive margin of safety just in case the manager is hiding a dumpster fire. It essentially stops a liquidity crunch from turning into a solvency crisis just because of a lack of information. It's Apollo admitting that in a world where the 10-year is sitting at 4.39%, you can't just sell smooth anymore. You have to sell real. And that reality is what keeps the big institutions from hitting the exit button when things get choppy. Alex, I think that's the perfect bridge into the deep dive stuff for Nerd Corner today.
Right, so you're seeing a real pattern here, Ray. Structural repricing in energy, central banks pivoting their reserve allocations, private credit forced into transparency, all of it pointing to the same thing. The old trust us, we know better playbook doesn't work anymore when the math is visible and the stakes are this high. Let's dig into that with Tom in Nerd Corner. So Tom, we've got this weird split happening. The hyperscalers and NVDA are ripping, but everything else in the AI ecosystem is getting crushed, and now the IMF is basically saying that concentration itself is the risk. Take us through the mechanics.
The derivative layer, AMD, Rocket Lab, AST, they need a very specific version of the future. CapEx keeps flowing, margins don't get competed away, and the multiple stays generous at the same time, which is a lot of ands for one trade. Yesterday was just that math showing up. NVIDIA up, everything else getting its knees taken out. The nuclear PPAs are the TEL 10 20-year contracts for baseload power. That's not an energy decision. That's them removing a variable from the equation entirely. Oil can spike, rates can move. Doesn't matter. Their input cost is basically pre-agreed. Oil is a headline. AI is a contract. Now the IMF thing. They're not saying AI is dangerous. They're saying everyone is building on the same stack and increasingly using similar models to manage risk. That's 2008's problem, when all the VR models agreed mortgages were safe. They were all wrong at the same time. And more importantly, they all reacted the same way when that flipped. If AI-driven risk systems all see the same signal in a liquidity crunch, you don't get staggered selling, you get synchronized exits. And then the Anthropic piece just breaks your spreadsheet entirely. If there's a real chance models start training their own successors by 2028, your 3 to 5 year forecast isn't just fuzzy, it's structurally unreliable. It either means today's platform multiples are cheap because they capture an exponential curve, or it means the derivative layer gets obsoleted faster than it can amortize its capex, which is a polite way of saying you built the factory right before the product stopped mattering.
It wasn't just AMD, though. Yesterday, you saw GameStop down 4.8%, Coinbase down 2.5%, and Bitcoin down 1.7%. That's the whole speculative stack, moving as a single de-risking impulse. The market is dumping the liquidity proxies that only survive if the macro narrative stays perfect. So the IMF's warning about systemic concentration feels less like a theory and more like yesterday's tape. But Tom, you're saying they've immunized their electricity bill, and they haven't immunized their stock price from the Fed. If this rally is just a massive duration trade, priced at 35 times earnings while the 10-year yield sits at 4.4, what happens to that safe status when the Fed eventually moves? Does a 20-year power contract really protect your multiple when the discount rate starts climbing?
The memes the of Waita. What's the peep baits hit when the munwetsats that are cash flow flows, near-term cash flow and pricing power. So when rates rise, they can grow a can't decuff. A PPPA imian. The reprice compute could they can read crow nightmarites. So you're legends, the multiple people. And then you're rect Michael click the games.
If I'm sitting at home with real money, I'm buying the platforms where the cash flows exist right now, Microsoft, NVDA. Because when rates move, at least I've got earnings that can grow into the valuation. The derivative layer is a belief system, and belief systems don't pay you while you're waiting. You need the patience of a venture investor and the risk appetite to watch your position get cut in half on a multiple compression, knowing you might be right about the thesis but wrong about the timeline. Most people don't have that. Most people sell in month 7. All right, we've got the calls coming up next. Let's see what we're actually willing to put on the board. Okay, so yesterday we all swung and missed. Tom needed AMD down 5%, got 2.1, Ray wanted gold up a full percent, and landed at 0.17. And I somehow called a range that the S&P ETF split the difference on and still ducked under. 0 for 3. That's what happens when you're fishing in the pre-market noise instead of waiting for actual conviction. Today, I'm looking at the QQQs. They're up almost a full percent in the pre-market, and that feels like a relief bounce that doesn't hold. My call is the QQQs close below 698. I'm wrong if we get some late-day bid into the close that takes out the open from here. Tom, you're up.
NVIDIA closes red, down about 1.5%. Call it 210 by the bell. You've got the 10-year sitting at 4.39. And that's just a quiet multiple compressor all day. I'm wrong if it reclaims 216 and holds it into the afternoon. Then the flows are still in charge. On your QQQ's call, yeah, that pre-market bid is just people renting confidence for a few hours.
I'm totally with you on that yield pressure, Tom, because when the 10-year is knocking on the door of 4.4, it's the market finally admitting that higher for longer is the actual rent we have to pay for this sticky inflation. My call is that the 10-year yield finishes today above 4.41% as investors realize no one is coming to rescue the bond market before the weekend. I'm wrong if we see a sudden flight to safety headline that drags the yield back down below 4.35.
So if you're right, we're basically saying 4.4 is the new floor until somebody actually has to do something about it, which is not this week.
All right, we'll be wrong again tomorrow, just with more confidence.
Consistency is a virtue, right? Have a great weekend, everyone. Try to look at something other than a candle chart for once.
Thanks for listening to 3 Clowns. You can find us at threeclowns.co, on Spotify, and on YouTube. We're off next week, so see you back here the 19th. Have a good one.